Is the Shanghai composite the world's worst long-term investment? I'm going to answer that question in today's video. Now, on the article below, I wrote about how a publication in China, which is a little bit on the kind of propaganda side, let's just say, tried to say that the China stock market has outperformed this year due to the coronavirus and the fact that China's response has been, according to them, better than some countries. And I wrote a response on this particular article, and the main issues with the article is this. Number one, since 2006, China's stock market has been one of the worst performing in the world, as you can see on the graph on the screen. So basically, China's stock market was at 6,000 in 2006. Now it's at about 3,400. So it's almost halved in that particular time frame, whereas the US market has gone up by about 300%, with the Nasdaq doing about 500%. Now, of course, this doesn't mean every year China has done badly. For example, in 2015, the Chinese market briefly went to about 5,000. And likewise, the last year, China's market has picked up again. However, long-term, China's stock market has been a bad performer. If you go back, of course, say 30 years, then it looks much better, but it's still not particularly great compared to, say, the US markets. That doesn't mean that's always going to be the case in the future, but we shouldn't look into short-term performance too much. Now, number two, the Nasdaq has outperformed the Chinese stock market this year considerably, but most people don't think the US has done particularly well with the virus. Number three, New Zealand and some other countries' stock markets have not done particularly well, again, especially relative to the Nasdaq, but also US markets. Number four, actually many Chinese firms are listed on the US and other major stock markets. So even if you took this argument that it's because of the pandemic, then actually, because American firms make quite a lot of money in China, or some of them do, and some Chinese firms are on the US stock market, then the US can also benefit from whatever's happening in China. So basically, to cut a long story short, we can't say that the pandemic is linked to stock markets at all. As I've said before, from 1918 to 1920, there was, of course, the Spanish flu and there was a world war, but stock markets did quite well in many countries. So the two things are not linked in any case, and that's been shown again this year, because the US stock market is still up for the year, and many stock markets are. So we can't read too much into these kind of things like stock market returns relative to what's happening with the pandemic. Now, with that being said, it could be argued that China's stock market is still quite undervalued compared to some stock markets because it has been struggling since 2006. So I'm not saying that the Chinese stock market is automatically going to be the worst performing stock market in the next 15 years in the same way as it has been one of the worst in the last 15 years. But let's not read too much into it. Even if the Chinese stock market doubles, for example, in the next 2 or 3 years, that will just bring it back pretty much to where it was in 2006, especially adjusted for inflation. So I wouldn't look too much into it. And the China market, one of the reasons it is a lot more risky than, say, Hong Kong and especially the US markets, is that it's mostly run by retail investors. What I mean by that is, the US S&P 500 and other major US stock markets, about 80 to 90% of the money usually is controlled by banks, hedge funds and institutional players. And most of the last 10 or 20% is controlled by people who are, relatively wealthy. Now, don't get me wrong, more than 50% of the US population own stocks, but of course richer people own more stocks than poorer people. So the reason that's less risky from the point of view of investing is, regardless of what's happening with, say, US unemployment or all those kind of things, at the end of the day, most of the stock market is not controlled by the average person anymore. It's not like the 1950s. So even if the US stock market went into or the US economy went into a very bad recession, that doesn't automatically mean the stock market is going to suffer, because the idea that just because people have less money, they're going to buy less stocks, that doesn't work in a market which is mainly controlled by institutional investors and, to a lesser extent, wealthier and richer people. Whereas in the Chinese stock market, it's much similar to how the US was a few decades ago. A lot of the money is still controlled by average investors. And in China, even though in the West, Chinese people have a reputation as being very risk adverse, when it comes to the stock market, very few people have this idea of buy and hold, unlike say in America and some European countries. So I saw it when I was living in China. People would say things like, oh, I bought a stock on Monday, I sold it on Wednesday, I got the profit, or oh, I sold because I'm down or something. People are buying and selling, buying and selling. So the market is prone to these very huge spikes. So for example, before 2006, the Chinese stock market went up by like 300 or 400% in literally 1 or 2 years. And in 2015, again, it pretty much doubled. The Chinese stock market pretty much doubled in 1 year, and then it pretty much halved back again. So usually, as I said before, volatility and stability aren't usually linked. But in the case of the Chinese stock market and some of our emerging stock markets, what you find is, in this case, volatility and risk can be much more correlated, because what's happening is retail investors are much more emotional all around the world than institutional investors, especially smaller retail investors. So these spikes are often completely irrational, even beyond, stock markets are usually partially irrational short term, but much more so in this case. The analogy I would make is this: imagine the US starts a new stock market this year, as an example, and pretty much 90% or at least 60-70% of the money is controlled by small time players who are investing 1 or 2 or 3,000 on eToro or one of these DIY platforms, typically younger people, 19, 20, 22, 24, whatever. You don't exactly have to be an Einstein to work out that that market will be much more risky than a market which has got trillions controlled by institutional players, because institutional investors, they can be irrational. Of course they can, just like anybody else, but you take it, if the US stock market collapsed by 40% next week, there's a good chance institutional players will come in and say, well, actually, this is a good buying opportunity. So markets are prone to this irrational exuberance, regardless of whether it's institutional investors or the average person, the average DIY investor. But on average, those markets which are more controlled by individual investors, like the small caps, like some emerging markets, they do have more risks associated with them for this reason. So it isn't just China, it's many other emerging markets. I do think though this situation will change over time. Probably in another 30 years, the Chinese stock market will be mainly controlled by institutional investors, also more global investors as China opens up its market more. So this point is not going to last forever. But right now, as of 2020, the Chinese stock market is much more risky than the American stock market or even European stock markets, and you're not going to necessarily be rewarded with better returns long term, because even if you look at 30 or 40 years and you compare the Chinese stock market to the US stock market, China has lagged a little bit. So the last 14, 15 years, the US stock market has beaten it easily. But even if you go back 30 or 40 years, the Chinese stock market has not beaten developed world stock markets, especially the US stock market. So you're taking more risk if you buy China without being compensated for more gains. And that's pretty much the issue there.